Good evening, everyone, and welcome to Economists on the Economy, featuring John C. Williams, President and CEO of the Federal Reserve Bank of New York, with Rebecca Patterson, Chief Investment Strategist at Bridgewater Associates and CEE's new board chair. Tonight's event will feature John and Rebecca in conversation, followed by audience Q&A. So please feel free to ask questions throughout tonight's proceedings using the Zoom Q&A button that should be at the bottom of your screen. With that said, I'd now like to turn it over to Nan J. Morrison, President and CEO of the Council for Economic Education, for her opening remarks. Nan?
Thank you, Thomas. Good evening and welcome to all of our guests. You may have noticed that there is still some lingering light in the sky. Sunset at 6, a token of longer days and warmth ahead, a preamble to spring. For myself, I'm hoping that this spring is also an envoy from life's better side. Less stress, more fruitfulness. For those of you who do not know us well, CE was founded almost 75 years ago to bring economic and personal finance education to K-12 students. In the furtherance of that mission, we do it all. Train teachers, develop the resources for their training and for the classroom, write standards, advocate with state and local leaders to get this into the classroom, and develop exciting, engaging programs for our kids. Many of us here tonight who work in finance or who have worked in finance often fail to recognize how exceptional this knowledge is for far too many of our citizens. Economics and personal finance need to be ordinary knowledge, not exceptional, ordinary. Understanding debt, credit, investing, insurance, saving, all the tools for building a life in a modern economy should be as accessible to our kids as downloading an app. For these subjects to be cloistered as the exceptional knowledge of the privileged few deprives the rest of an essential key to security and economic mobility, to the fruitfulness for which this knowledge is the preamble. And it is more than that. When the promise of our political and economic system withers into multi-generational disappointment and deprivation, we undermine its stability and endurance. I think that we all recognize the call to greater equity and the need to provision for it. And CEE is doing that. We're utilizing our newly designated access zones to target our resources even more effectively. We're expanding our Invest in Girls program, and we're capitalizing on virtual learning to provide even more flexibility for teachers and students. On April 6th, our annual benefit will take place at the Plaza Hotel. After 2 seasons without seeing you all in person, I am truly looking forward to this. We are also live streaming to accommodate all. We have 3 amazing women as our honorees this year. Our benefit's always been a great venue for schmoozing with your peers, being entertained by the redoubtable Steve Leisman, and hearing from leaders in our field at a fireside chat with our visionary award winners. And of course, it's a chance to get to know all of us. Please consider joining us for what we expect to be a very lively celebration. Prior to that, on March 17th, second to last announcement, we are releasing our latest survey of the states, which takes a close look at the standing of economic and personal finance education across our country, our progress or lack of it. It's a media edition as we explore bottom-up as well as top-down initiatives, always in the pursuit of what works and what gets us there. You are all invited to listen in and can find more information on our website. All of this is preamble to another spring for CEE. But there is one more announcement and an introduction. CE's board chair, Barry Hames, has stepped down. He remains on our board as chair emeritus, and I know he's listening tonight. Barry did yeoman's work in bringing CEE through the storm. We could not have made it without him, let alone actually improved in the tempest. Nevertheless, he felt it was time for new blood, and so I have the pleasure of introducing our host for this event and our new board chair, as Thomas mentioned, Rebecca Patterson, Chief Investment Strategist at Bridgewater Associates. I'm certain that most, if not all of you, know Rebecca or know of her. Reciting her CV doesn't begin to capture who she is after 20 years of investment management experience at JP Morgan, Bessemer Trust, and now Bridgewater. Needless to say, Rebecca has been named to America's most powerful women in finance for 6 consecutive years, all, not to mention being a part of our board, all of which might conjure up a person who is, maybe Wall Streety in not the best ways. No, instead, Rebecca is in fact a gracious, generous, interested, and formidably knowledgeable leader. She knows what finance is about, the rewards and the challenges. She also knows that living only in that world is not enough, and that's why she's here, to share the abundance and transform a preamble to spring into a mighty summer for all. Welcome, Rebecca. She has the honor of introducing our esteemed guest, John Williams, President of the Federal Reserve Bank of New York, in his first appearance for CEE, and hopefully not his last. Rebecca.
Thank you so much, Nan. That was an amazing introduction, and I'm humbled by it. I'm going to try to keep going, though, and not sit here and blush, because I know everyone wants to get to the content of this conversation, which is what is on the mind of John Williams, President of the New York Federal Reserve. John, I'm so grateful to have you with us tonight. As chair of the board of the Council for Economic Education, we pride ourselves in having these conversations, economists on the economy, where we can do a little bit of that education sharing with our broader audience. And having you here is really just an incredible treat. So thank you very, very much. John, we're going to get right into it because I have a feeling we could go on for hours tonight, and I'm not going to do that to you. So I want to start with uncertainty. As you know all too well, steering economies successfully has been unusually challenging over the last couple of years with the pandemic. Without knowing how the pandemic will evolve and who did, we still don't know for sure going forward. And now it's harder to know where the economy will evolve. And now we're looking at not only the pandemic, which seems to be getting better, but still with us. In addition to that, we have Ukraine. So the question I have for you to kick us off tonight is, how does the Fed think about managing risks around policy decisions when you don't have as much clarity about the outlook, especially since we know monetary policy feeds through to the economy with a lag? You have high inflation today, but 12 months from now, who knows? So I'd love to hear your thoughts on how the Fed navigates periods like we're going through today.
Well, Rebecca, thanks. Nan, thanks for the invitation to speak to the group. I'm been looking forward to this discussion. And you've asked me a great first question. On my, I guess on my CV, it says my research interest, going back to early days of my career, is monetary policy under uncertainty. And many times I've been asked, who studies monetary policy under certainty, since that doesn't actually exist. But it is the reality that we always operate under, that there's uncertainty. But you're absolutely right. The past few years have been an extraordinary period for shocks to the economy that we've never seen before in our lifetimes. Really hard to fit into standard categories. As economists, we tend to think of supply and demand, but this is really a health crisis and obviously a pandemic, which has effects on supply and demand in ways that aren't kind of easy to categorize. Also, going back to March of 2020, when this really got bad here in the United States, it was just, we didn't know where it was going to go. And we started looking at lots of epidemiological models and obviously talking to the experts on pandemics and understanding that and the uncertainty about when would we get treatments, when would we get vaccines, and would they work? And so that's been exactly the world that we've been working under. What it's taken is, I think, where I started, monetary policy is always conducted under uncertainty. It always works with a lag, as you correctly point out. And it's just really, taking those lessons and applying them, and also really being very nimble of trying to find new sources of data, expertise, and analysis to help us clear some of that fog about the economic outlook. So I'll give you a couple examples from the last couple of years. So one is the data that's now available. We now, as a macroeconomist, someone who studies the whole economy, you probably think I'm looking at GDP and inflation and interest rates and employment and unemployment. Well, but now we have all this data, from various sources about this daily data, granular data about small businesses, from companies that, provide services to those companies. We have the data from the various companies that, about hotel reservations and airline reservations and things like that. So we have all this micro data that allows you at a high frequency see what's going on on, day by day, but also allows you to see what's happening in different regions or different metropolitan areas or different countries. So one of the things during COVID, of course, is it swept across the United States, or swept across the globe. So we have all this data that allows us to see what's happening, how what happened in this area may be coming, our way, or maybe moving across the country around the world. So I think the availability of that data has been a huge game changer in our ability to understand things. The other thing is as we've gone through the cycle or the various waves and variants, is really learning along the way and saying, well, this is how the economy responded to this wave. How is it responding to that? What should we be looking for? And really, being nimble about that. But at the end of the day, the question you're really asking is, how do you make policy? You don't know all that. How do you decide what to do when you don't have that uncertainty? And there, it's really about risk management. I think Chair Powell has spoken eloquently about this throughout, that we have a great deal of uncertainty. We have to manage these risks. We often get asked, what's your forecast for inflation? What's your forecast for employment? And those are numbers, but those are numbers that were just part of a distribution of kind of possible scenarios. And so we're really focused on, like back in early 2020, what are the possible paths the economy could go on in terms of the recession, in terms of employment and the financial markets and inflation. And there, the risk management was telling you very loud and clear, worry about the worst case scenario. Things could get worse. Let's make sure that we manage against that, cut interest rates dramatically back in March of 2020, do the largest asset purchase programs in history, really protect the economy from things getting really bad. Things got better, have gotten a lot better. I'm sure we'll talk about that. But then, again, it's the management of those risks. How have those risks evolved? The economy's strong now. We're not in March 2020 anymore, obviously. And clearly, there are these upside risks to inflation and other uncertainties that we have to take into account, and then again, manage those and really try to protect, making decisions to protect us, the economy, from things that are maybe the bad scenarios, rather than just focusing maybe on the baseline. And the last thing is being I think, willing to adjust and adapt when the data change. I know you've heard me say this, but we have to be data dependent. And you watch the data, you analyze it, you come to a decision. We meet every 6 weeks. We can revisit that. These aren't decisions forever. Revisit them, come to a decision, and move forward from that, trying to be as transparent about our thinking and our decisions as we can be, given the uncertainty. And then, again, try to make the right decisions as the information changes. So I think there's a lot of it. A lot of it's all the data that we can get, the analysis we can do. It's about risk management, and it is about being transparent and open to shifting course when the data and the analysis tells us that's what's needed.
And just a quick follow-up on that then, John. So you mentioned risk management, transparency. It felt that Chairman Powell in his testimony to Congress this week might have been doing a little bit of both, telegraphing that the March FOMC is likely to result with a 25 basis point rate hike, whereas the markets going into that, we're thinking maybe a quarter, maybe 50 basis points, which to many people watching this tonight, they'd say, well, who cares? It's 25 basis points difference. But to people who are trading these markets day to day, it's material. So it's a very big difference from 10, 20 years ago when Chairman Greenspan, I think, almost took a little bit of pleasure in obfuscating. So I'd just be curious, do you think that telegraphing was partly a risk management judgment?
I won't speak for Chair Powell's particular thing, but I will say that under his leadership, we have continued to become more and more transparent, more open, and I think he's very clear also, and I agree with this, is that risk management is core to what we do. Now, I started at the Fed in 1994, and that was a few months before I joined the board in Washington. Was the first time the FOMC had issued an FOMC statement after a policy decision. So that puts things in perspective, or it dates me. It probably does both. But so early '94 was the first rate increase that they had done in a number of years, and they put out a statement almost apologetically saying, well, here's what we did. Nowadays, we've learned that monetary policy can be more effective the better we are at clearly communicating our thinking. Well, first of all, our strategy, and that's why it was since 2012, starting with Chair Bernanke's leadership, we have a long-run goals and monetary policy strategy that's written out, put on the website, and guides our longer term strategy. And then, try to communicate as effectively as we can through our statements or communications, the thinking behind it, and obviously what our plans are to the degree we can. Now, often I think that what's important in our communication is not, are we going to take specific action? You gave it a good example. Is that the most important part? I think the most important part is really about laying out the view we have of what's the most important factors that are driving, the economy and our decisions, and how we're thinking about that. And I think that, the market participants and the public, I think that really helps them understand how we're thinking and what we're planning. Of course, they may have different views and come to their own conclusions, but at least, we're not adding, if you will, noise. So I think the days of, and again, I think give some credit to Chairman Greenspan. He made a lot of those changes for greater transparency during his years. But you're right, early on, I do think that the view was the less we say, the better it is. And that definitely has changed. And I think that the transparency has helped make monetary policy more effective and actually shorten some of those lags that we talked about, because people don't have to spend months and months figuring out, well, what did we mean? They understand what we mean. Market can move more quickly to when we change, maybe our kind of direction.
No, that makes good sense. I want to step back a minute, because I've been in conversations recently with, frankly, a lot of Monday morning quarterbacks who will say, well, gosh, why hasn't the Fed started raising rates even sooner? Look at where inflation is. Core PCE at 5.2%, highest inflation since the early 1980s. But, 6 months, a year ago, the consensus was not looking for inflation at these levels. But importantly for this conversation, neither was the Fed. And I'm not trying to point a finger. Again, the whole consensus was not looking for this either. What I'm curious about is, how does the Fed learn from this? Obviously, the economy evolved in a way that you didn't expect. So you have armies of PhD, really incredibly brilliant people working there, and you missed it. So when stuff like that happens, do you come back and debrief? Do you say, okay, here are the lessons learned, here's what we need to do differently? I'd love just to hear your thought on how you go through something like that. When you miss an economic trend, and obviously the pandemic was so unusual, what do you do to make sure you don't miss it again in the future?
Yeah, absolutely. We constantly do that. And, you said, we have a lot of economists, a lot of PhD economists, and thinking through those issues. We have a lot of different models and different types of analysis we do. And there's always that process of revisiting, you look at your forecast errors and, what did we miss? Or sometimes maybe it's just something you couldn't predict. But sometimes, you really think, okay, so there's something going on that we didn't see, but we see it more clearly. How can we learn from that? So that's been going on constantly for the past 2 years. Well, it's been going on throughout my career. I think, when I go back and, ask myself that question, I do think that one of the things that's happened very differently than I think I expected, just speaking for myself, is that the pandemic has continued in waves that have continued to contribute, and not alone, because I understand that there are other factors contributing to the inflation, but have continued in ways that I didn't expect. I thought, maybe overly optimistically after, ex post, that the availability of vaccines and now treatments around the world would really open up the supply in our economy and more globally. So we would see the supply chain issues, the labor shortages, a lot of the factors that I think have contributed to the higher wage increases that we've seen and higher inflation around the world. I think that those have just lasted much longer. The other thing that's happened that has been a surprise to me is that demand or growth in the economy has been really strong. We had 5.5% real GDP growth last year. That's great. The recovery has been, astounding. It's been rapid. We've seen, millions and millions and millions of jobs added. Unemployment's down to 4%. So we've seen an economy come back even through the waves with very strong, continuing strong demand for goods and housing. And I, again, would think that as we got through the pandemic, which, I think we're still doing, but I would have thought earlier that, people would have stopped buying those durable goods that they were piling up. And, we all did it. We bought, living at home, working from home, we bought more furniture. We bought heat lamps for us in the Northeast. We did all those things, but people are still doing it. Durable goods purchases today are still way above where they were before the pandemic, and housing demand clearly has shifted out as people have adjusted to this new normal. So there's been a lot of lessons learned about demand is stronger than we thought, that the supply chain issues are, I think, more lasting and severe. And this isn't just in the US, but around the world. And of course, now we have, as we all know, the oil price increases associated with the invasion of Ukraine. So I think the lessons here is to reassess, what were the things that were the surprise that, maybe, that's just the way it was. What are the things that maybe we weren't thinking about right in terms of supply and demand, and then, come up with our new forecast. Clearly, the punchline is inflation is much higher than we expected. And I expect inflation to stay, come down this year, but still be well above our 2% goal. So really that reassessment is telling me that inflation is going to be higher for longer than we thought. It's still, we're absolutely committed to bringing inflation back to 2% and taking the actions necessary to do that. But that's how I view the reassessment of things. I do also look at what's happening in other countries, because in the U.S. we tend to focus a lot on our economy and focus on that and really try to cross-check what's happening in other countries. Are those similar or different, and what do we learn from that?
I agree. I mean, I think in the United States, so often people focus here and you forget the feedback loops from other countries to the US in a myriad of ways. I want to stay on, I promise we won't stay on inflation the whole time, but it is extraordinary right now what's happening. And when I think about the war in Ukraine and what it's doing to commodity prices, we're seeing oil prices up over 40% year to date, some other commodities up well over that. And it seems like, just when we think we're getting out of the pandemic, here we go with another shock, a human tragedy first and foremost, but also an economic shock. And what I want to talk about with you just for a minute here is, okay, at the margin, we don't know how long this will last, but we know it's likely to push inflation even higher as commodity prices pass through to broader inflation and maybe to inflation expectations. But there's always the risk that it's also going to feed through to spending, to the growth. Right? When we see gasoline prices in the US today starting to tick higher from $3.50 a gallon and going up, people have to spend more to fuel their cars, to heat their homes. Do you still think, because of the strong growth backdrop we're starting from, that we're in a reflationary environment where growth and inflation are both rising? Or how do you think about the risks of stagflation, that the inflation becomes so great and broad that it starts to undermine the growth part of the economy?
Well, the uncertainty around the economic outlook is very great now, and obviously the situation in Ukraine adds to that, and in the ways that you talked about in terms of commodity prices and effects potentially on confidence in Europe and around the world, and a lot of different channels, financial market channels as well. So that's clearly a significant risk. And as you said, I just want to reiterate, this is first and foremost a human tragedy, and we're going to talk about economics because that's what we're here for. So to me, for the U.S., I think it's a little different for Europe. I'll talk about that. I think for the U.S., I would think the first direct effects are higher energy prices passing on to higher inflation. And obviously we have to factor that into our forecast and views of inflation, and understand how long lasting that will be in terms of the effects on the economy. I do think on the, typically the way we think about a supply shock to oil like this, a negative supply shock to oil, is that it's kind of like a tax to American consumers. That's why you talked to, that's the way you talked about it too. So that has some hit on consumers' ability to spend, real income, disposable income. I still think that's happening in the context of very strong household balance sheets. People still have a lot of savings, built up from the various programs to support household incomes over the past 2 years. So I think the consumers' balance sheets, businesses' balance sheets, and situation is still very good. I think the economy is coming into this with a lot of forward momentum. So I definitely think it's somewhat of a drag on the consumer from the real income point of view that you mentioned, but I don't think it's definitely not a stagflation issue. And the real issue here is on inflation, is the one you said, is this it boosts oil prices, but then they just basically stay high and eventually will come back to normal levels, or is there a second kind of second round effects that we would say, on inflation expectations or wages. And one thing that we've studied very closely at the New York Fed, and I've been involved in some of that with my colleagues, is that, the good news here is inflation expectations have not really moved that much. They always move when inflation is high. People expect inflation to be high over the next couple of years. That's normal patterns that we've seen, even when inflation expectations are really well anchored before the pandemic. The good news here is we're longer term inflation expectations, when you look further out, they clearly are not moving that much. Households, consumers in the US expect inflation back to where it was, or expect inflation to come back down to the same level as they thought before the pandemic. And in the markets, I know you watch this carefully, we're seeing the same kind of pattern. We don't want to take that for granted. We got to make sure we as the Fed, take our actions to get inflation back down to our 2% goal and to make sure the inflation expectations stay there. But so far, we're not seeing signs of that kind of process, underway. And so, both in the, all the different measures we look at inflation expectations, they still seem to be very well behaved. And I think we're benefiting from, decades of the Fed, delivering low and stable inflation, and that commitment to do that in the past. And of course, we have that commitment to do that today and in the future.
I completely agree. And I think one of the reasons we're not seeing inflation expectations de-anchor at this point, at least, hopefully they won't at all, is the last couple of decades of monetarism that's built up the Fed's credibility and is in a way buying you a lot of time and goodwill, which I think is a testament to the work the Fed has done since the 1980s. I want to stay on inflation and growth, but pivot a little bit to the corporate sector. You mentioned wages and inflation expectations. And one thing we've seen with this very strong nominal demand in the economy and higher inflation, but most US companies so far feel that they can pass on those higher input prices, the commodity prices, et cetera, to their end customers. And customers so far are willing to pay it. And that supported profit margins. And at least until very recently, it supported equity prices really nicely as well. And we're seeing that in things like the Fed's own beige book, as well as quarterly earnings. And I'm wondering, when you think about this dynamic, is it good news in that healthy companies and a supported stock market clearly have positive wealth effects for the economy? Or is it maybe more mixed, because it could contribute to a wage price spiral? To me, is a little bit exaggerated and hyperbolic as a term, but to the degree you're seeing that we've got a tight labor market, we're able to pass prices through, but if we keep passing prices through, people need higher wages and they can demand the higher wages right now. And so it could become a bit self-fulfilling. So in a way, I would almost wonder, is it too good news, right? Is it great that we have strong companies and we should just celebrate that and good profit margins, or is that an element of it that perhaps is on the tipping point?
Well, it's a topic that I've been hearing about all my career. This issue of do companies have pricing power, and so let me talk about that specifically. And when the companies don't have it, they complain, and when they have it, it's like today they say they do. And I've often, as an economist, tried to understand what that means. Like presumably you're profit maximizing, setting your price in that way. I think what it means is the demand is really strong, especially in some of the goods, housing, and some other areas. And so when demand is strong, consumers clearly are willing to pay higher prices. We hear that all the time. You can see that, all over the place. And then, businesses are saying, well, okay, I can do that. Of course, they're all facing higher costs from wages or commodity or import prices or other things. So there's a real kind of set of circumstances. But I think what's happening is with very strong demand, the consumers say, hey, I want to buy that car. I need a car, and I'm willing to pay the higher price than I was a few years ago. So I think we see it in the data. I think we see it in all the indicators that you're talking about. I don't think that's really linked to the wage price dynamic, which you mentioned. I think it's really just a restatement in a way of the very strong consumer demand, especially in some areas. And you see it in housing. If you look at rents in Phoenix. Or in Florida, I mean, they're skyrocketing. People have been working remotely. They want to live in warm weather locations. Their employers are letting them do that, and there's a fixed housing supply in the short run, and you see the price of people willing to pay those higher prices. So I think that's the dynamic. And I think the interesting question for me is, well, hopefully this pandemic ends and it turns to more of an endemic status, and hopefully we're able to get back to whatever the new normal is, but that means going back to traveling more and going to theater and concerts and things, and doing more of this in-person services, which have not recovered in the same way the goods have, and people stop buying as many goods, and things kind of rebalance in that way. I do think that that some of that pricing power will then shift away from that, and maybe shift a little bit more to the rest of the economy, because I really think some of this is about the imbalance in the U.S. economy, where certain sectors, including housing, which is a very important one, have seen just very strong demand, and other sectors haven't. And in those sectors, you don't hear the stories about the pricing power. So we'll see how this plays out. Again, I guess you're going back to the earlier question. We're gonna have to watch the data, analyze this, and see how this develops as we go through this year. But I think that those are how I guess think about some of the pricing power, and obviously the profitability of companies that you mentioned, and how that fits together. I mean, one thing though is, last fall when we had the kids coming back to school and schools reopening, there was a hope that maybe we would see this surge in labor supply, and that would help rebalance the economy. But that has taken a lot longer and moved much more slowly than we expected. So one of the things I've learned from that experience is that some of these adjustments coming through, even through Omicron, they may just take longer than we previously expected. The economy roared back, but these adjustments of kind of relative demand for different types of goods and services, people coming back into the labor market who left in the last couple of years, this just may take longer than we definitely is taking longer than I thought 9 months ago.
And there's probably a question if even a segment of that labor market never comes back. I mean, one thing that's been interesting to me with the retiree population, the older workers, in the past, they did come back after recessions. One thing that's different this time, though, is from the beginning to the recession to today, the stock market has shot higher. Their house values have shot higher. Their savings rates shot higher. Before, they weren't financially able to say, I'm done. Today, they are if they choose. And so I wonder if that could be a factor that doesn't get you that supply of labor. Again, it's just one piece of it, but to the same degree as you might expect otherwise from past cycles.
Yeah, it's something we've been watching, obviously very closely. We also know that a lot of people, quote unquote, fail at retirement. I've been told that I'm probably highly likely to fail at retirement. But so we know from the data, from the micro data, that a lot of people who have retired often come back into the workplace. But economic factors, matter. Wealth matters. What the opportunities are in the labor market. We know a lot of people who are in that retirement age or would like to have part-time work or different type of work than they did during their life. So there's a lot of dimensions to this. I think you have to have a big dose of humility in terms of, do we know what's happening? A lot of people who are younger have left the labor force that aren't retired. So I do think there's still a lot more labor supply out there. It's just going to take a while to figure out how much that is and when that comes back.
So you have a policy decision meeting coming up in a little over a week and a half, and it's so interesting to me when I've been watching the markets throughout this pandemic cycle. You mentioned the labor markets, which are incredibly tight, tightest we've seen in decades. Housing market that's also incredibly tight. As you said yourself, it's going to take a while to get supply to match demand, even if demand starts to moderate. And so the inflation pressures will moderate, question of how quickly. But yet, when you look at what the market is pricing in, financial market pricing, it suggests that very quickly, within the next year and a half, it'll be like the pandemic was a bad dream, with inflation back to your target and the Fed funds rising only to 2%, a little above that to get there. And when I look at that, I have trouble accepting that it's going to be that easy. Do you only have to raise the Fed funds that much, which is a lot less in terms of tightening versus historical cycle averages, to get inflation from where it is today to that 2%? And do you think the market's wrong in its pricing, or do you think, yeah, maybe it won't be quite there, but it'll be close? And then lastly, how does the balance sheet, I know it's a lot, I can repeat things. How does the balance sheet fit in? We haven't talked about the balance sheet yet. And we saw the Fed's balance sheet, rise a lot during the pandemic, a lot of asset purchases to keep yields down. And you are being more, I would say, active with the balance sheet, relatively speaking, this time versus history. So interest rates, your main target, but also the balance sheet. So how do you get back to that beautiful 2% inflation or close to it that quickly with such a small amount of interest rate increases? Or does the balance sheet do the rest of the magic for you? Just walk me through how that picture resolves itself, because I can't make the math work.
Okay, so Rebecca, when you started the question, I was saying, oh, good, I'm going to talk about the balance sheet because that's the missing piece. But then, of course, you mentioned it, so it's not the missing piece. But I think it's an important piece. So you asked a bunch of questions. There's exactly the questions I guess I spend much of my day working on and talking to our people about and our teams about the yield curve, how do we view market expectations. I guess first thing I will say is we don't know what it will, what exactly the path of the economy will be, or what the Fed funds rate needs to be at the next year or something. That'll depend on the economy. That'll depend on all the factors we talked about, and obviously supply and demand, but internationally too, what's happening, and all the things that are affecting supply and demand around the world. So we don't know that. There's a lot of uncertainty, and the market participants, investors who are in those markets are, they're weighing all that information and coming to their conclusions. So I don't know who's right or wrong. I think everyone's just trying to use the information they have and come to their best guess, of where things are going. So I think that's the first thing I would say. I do think that, the important thing, from my perspective, is it's clear with inflation so high, which you've mentioned a few times, but it's absolutely true, that we need to get monetary policy away from where we are today, which is really, shows where, the responses we took back in 2020 and through 2021 to support that strong recovery. So we've gotten the strong recovery, and that's great. We've got a very strong economy, a strong labor market, and really move away from that very accommodative stance of policy back to a more normal stance of monetary policy. And I'm using the word stance of monetary policy because I'm purposefully combining the idea of moving the federal funds rate target range from close to zero back up to two more normal levels, through a series of rate increases. Yes, and I would see that the first one should happen in our next meeting in March. But continue a path of steadily moving the funds rate back to more normal levels. So that's one part of it. But a second really important part of that is reducing our balance sheet. So basically reversing the asset purchases that we made in 2021 that supported the strong recovery, and moving that balance sheet back to what will be the new kind of normal levels for that. Now we laid out our principles for balance sheet normal or reduction. Importantly, as you said, the Fed funds target, should be the primary tool of monetary policy that we adjust as the economy changes, and the balance sheet reduction is in a way happening, more or less in the background. I do think that we are, obviously thinking through those issues and figuring out exactly how to design that. But I think and we will, make that decision when it's appropriate to do so. But I see this year as the year of both moving the Fed funds rate back to, toward more normal levels, through this year and into next year, and then also starting to engage on the process of balance sheet normal, reduction, and specifically doing it much more quickly than we did last time, and it's a much more sizable reduction in the balance sheet because our purchases were much larger this time. So we have these two ways of bringing monetary policy from basically adding maximum support to the economy, moving those back to more normal levels, this year, back in getting that process going. Now, if you look at how the markets have adapted to that back to December, you've seen a pretty sizable shift in financial conditions, expectations of Fed policy in terms of the Fed funds rate, expectations of this balance sheet reduction. Again, I'm not saying does the market have everything right. The point is what I see out there in market expectations is consistent with the basic viewpoint that I have of where we need to be moving. So that's a pretty powerful set of conditions that will remove some of that, very accommodative conditions that are supporting very strong demand for goods, very strong demand for housing, the interest sensitive sectors. At the same time, we've seen fiscal policy in the last few years be a big supporter of demand growth, getting the economy back on its feet, really powerful. That's no longer playing that role. And in fact, from a growth rate point of view, fiscal policy is a bit of a drag on the economy now. And then I think the most important thing I can add to this is a global phenomenon, right? All the countries, the advanced economies, almost all of them, not all of them, but almost all of them have the same issue of very strong economies, high inflation, and they're moving monetary and generally fiscal policy similarly. So we're seeing a global shift of monetary policy from very strong accommodation back to normal levels going on, this year, next year, I expect, and fiscal policy similarly doing that. So I think those are pretty big global forces that will take some of the pressure off inflation here and abroad. And I also hope that, the supply issues, as I mentioned earlier, those are also, we'll get past those as we get past the pandemic and really able to deal with the global supply chain issues and also some of the labor supply issues. So those are the various factors: monetary policy, fiscal policy, and kind of getting through COVID. Better supply that I think is going to help bring inflation down over the next few years.
Thank you for that. I want to start pulling in some of the questions I'm getting from the audience, and I'm going to address first our chair emeritus, Barry Haynes. He and another guest had asked, hypothetically, let's say a year and a half from now, you've started your monetary tightening cycle and inflation seems to be leveling off, but it's not leveling off at 2 or 2.2. It's more like 3.5. Mm-hmm. How long does the Fed let that persist before it feels the need to take additional steps? And, how is the Fed thinking if even at the end of this year, inflation's still above 5, which, given everything you said, is clearly not your view, but we also know with things like Ukraine, it is possible.
Well, I think we just go back to the thing, how I answered your question about when the forecast isn't what you expected, how do you adjust to that? I think one is the diagnosis, like what's causing inflation to be higher, what do we miss, how long do we think will last? So obviously it depends on the circumstances. So it's hard to know the answer without knowing the circumstances. I do think, though, that we have the ability to adjust interest rates higher if inflation ends up being much more persistent or staying much higher than we expect or want. So, we've said for decades, well, now I guess we've now said for decades, that is the lower bound on interest rates is a constraint. And it makes it harder to stimulate the economy when the economy goes in recession and interest rates can only go to roughly 0, at least in the US. But on the upside, obviously, we can adjust, interest rates, more quickly or increase them more in order to get interest, basically real interest rates adjusted for inflation and financial conditions in a position to make sure that inflation is not only not increasing, but bringing it back down to 2%. So we'll have to do that assessment. Is inflation behaving the way we want it to or expect it to? If it's not, then obviously we'll have to adjust policy to make sure that the condition, we create, monetary policy conditions that help move inflation back down. Right now, again, my expectation is we'll see inflation. We'll take the policy actions needed, to keep inflation in check and bring it back down to 2%. But if a scenario like that happened where it seemed to be stuck at a higher level, we'll just have to take the actions to bring it down in that situation. But it will really depend on kind of what are the drivers, what's the specific conditions that we're talking about.
I did get one question, which I've asked before to various Fed officials, but I feel like for the audience, we should ask it for anyone who's still new-ish to this. Why 2%? Why not 1.5? Why not 3? I mean, for the last decade or two, the US and a lot of countries around the world, Japan, certainly, I'd say increasingly in Europe, and even in the US, we weren't fighting deflationary risk, but we were certainly fighting low inflationary risk, which would limit the Fed's ability to ease, given that we didn't want to go below 0. And so why stick with 2? I know there was a lot of discussion before the Fed rolled out its new framework last year. So I don't mean to trod through all of that again, but if inflation settled at 2.5 or 3, could you argue that's maybe fine, right? It means that you're further away from the lower bound, but maybe it's not problematic. Is there a magic behind 2?
Well, there's no magic behind any of this. I mean, it's a lot of analysis and, judgment. I do, there's a lot of experience here in the US and around the world that, go and we revisited that, here that, 2% inflation provides enough of a buffer for the, during a downturn to cut interest rates, even with a lower bound. We can use other tools like asset purchases, which we did, and provide the support for an economic recovery and an expansion. So 2% inflation was sufficient, if you will, to do that. And higher inflation carries with it costs. We know that high inflation harms those who can't protect themselves against inflation. So you think about the way I've always thought about this is we have the maximum employment and price stability goals. If you set inflation target too low, it's really hard for monetary policy to respond to a recession or a downturn. So that makes it hard to achieve the maximum employment. But of course, if you have inflation that's too high, you're undermining the effectiveness of the economy and again, interfering with the ability to really have kind of the maximum potential for the economy. So the 2% inflation, it's not magic. It came out of a lot of, I think, studies and thinking, and I think it's still the right one. So no, I'm definitely in the, I am in the camp that we want to get back to 2%. That's the right answer. Of course, when inflation is 1.5, I'm pretty consistent on this. I said 1.5 wasn't good enough either. So I think you set a goal, you do what you take the actions that you can to achieve that goal. And I would go back to what we said about inflation expectations. They're still anchored where they were, before, earlier in the previous decade. And so that's in our favor. So let's not move the target around. I think we have inflation expectations in a good place. Let's just make sure that we get inflation back to that.
Great. So thank you. That was very clear. You mentioned maximum employment. So I want to go to the employment side a little bit. One thing the Fed did when it refined its inflation framework, it also announced what I consider some refinements to its employment target, that it was now explicitly taking into account, maybe it implicitly did before, but now it was very explicit. We're going to look at different socioeconomic cohorts. We're going to make sure maximum employment applies to the economy overall, not just at a headline level. And I'm wondering, with inflation rising, that could hurt certain cohorts more than others. But what are you seeing on the maximum employment side? What are you seeing at different strata of the economy today?
Well, you're absolutely right. One of the things that came out of that review, and something that we take very seriously, is looking at a lot of data, cutting the data across a lot of different dimensions, really trying to make sure we understand the full labor market experience, not just the unemployment rate, which honestly was the number we pointed to the most in the past, but really looking much more in much greater detail and understanding what's happening. We saw in the last expansion, going into 2019, early 2020, a really long sustained expansion really benefited a lot of people who hadn't benefited before. Some of the lower paid workers saw bigger real wage increases. We saw much lower unemployment rates for groups that historically experienced higher unemployment rates. So we know that having a strong sustained expansion is great from that dimension. And then what we saw tragically in the 2020 experience with COVID was a lot of those groups were hit the hardest by COVID. A lot of those jobs are lower paid jobs. A lot of jobs that are in the service industry, those people, lost their jobs, they lost their incomes because of that. And so, when I look for, kind of thinking about, are we having a full recovery and expansion? It's really looking at making sure that, as we get to a strong, sustained expansion, watching all the different parts of the economy, not just looking at the unemployment rate, not just looking at the job openings rate, but really looking at all of those pieces together. Now, the inflation, I'm a little bit out of focus now. Let's see if I can fix that 1 second. Okay, I think it's better.
You look fine here.
Okay, good. The thing we are seeing is, for those people on fixed incomes or people who have, a lot of expenditures for, you mentioned gasoline, but also for food, the high inflation we're seeing, that's hitting them the hardest. And so, low and stable inflation, we hear this from, all the people we talk to. I mean, that's really important for everybody. So I'm convinced that getting back to low and stable inflation of 2% is actually totally consistent with this kind of broader maximum employment goal that we described.
So, John, I promised we wouldn't talk about inflation the whole time tonight, and I have gotten a couple questions in. I'm reading them right now, so I'm looking down at my screen a bit. Cryptocurrency. You knew it was going to come up tonight, right?
Always
so maybe I'll try to frame it. I mean, one thing we definitely saw during the pandemic with the liquidity that the Fed provided and then the fiscal stimulus that the government provided, this 1-2 punch, is that a lot of folks ended up with greater net wealth after the pandemic than before, as you pointed out, and I think I mentioned as well, higher savings, et cetera. And that probably helped fuel a lot of interest in retail investing, both in equity markets, but also crypto markets. And so the question that came in the chat was, do you see this more as a short-term phenomenon? This is cyclical, and when the liquidity goes away, so does that? Or do you think that there's something more structural here? I mean, we have seen changes in regulations around certain types of retail trading, like options. We're seeing these platforms that make things basically free now. So I'm just curious, as the Fed withdraws liquidity, do you have any sense at all what could happen to some of these retail investors, whether they're in equities or in cryptocurrency?
Well, the way I think about this is that, technology, a lot of this is driven by technology, or like you mentioned, platforms, or, new business models around, whether it's for investors, or we could get into, cryptocurrencies and things like that. So there's a lot of technological change, a lot of disruption, if you will, out there. And I don't think that's going away. I mean, I don't think that's I think that's a part of our landscape in our economy, in our financial system, both here and around the world. I think the big, kind of public policy question is, really going back to some core principles that we want our financial system to support, the effective allocation of capital from savers to investors to support our economy. We want to protect consumers and investors to make sure they have the right, they have the information they need. There's, not fraudulent activity. And we also want to make sure that the financial system is working to support financial stability and not in some way creating problems for that. So, when I think about, more broadly innovation, I think there's incredible opportunities out there. I actually think this is probably, I'm going to say this, the first time in my career where I think technology can transform financial services, payments, a lot of things. I mean, there's all the discussion around digital currencies and maybe even central bank digital currencies, very topical issue around the world. So I think this is an exciting time for this. And what we're seeing is a lot of innovation, but some of it perhaps not meeting in my view, of the test of solid consumer and investor protection, and definitely not meeting the test on some of the financial stability and in money laundering and some of the other things. So I think this is a time where it's really important for innovation to happen and new products and new services to develop, at the same time for the regulatory community, both in the United States, and so a lot of this is not the Federal Reserve, I should be clear, it's more the SEC and others, but also around the world, that we really think of, if technology is transforming payments in more digital currencies and greater opportunities, let's make sure we're doing, kind of putting good guardrails on this and setting this up not only to serve the public and the economy, but also making sure that we're not creating the next thing that causes that contributes to a financial crisis in one way or another. So that's how I think about this. So it sounds like I'm kind of contradicting myself, but I am excited about the technology. Let's make sure that this is used in a way that really serves the public and helps our financial system, which is unique in the world. It's got this great combination of the banking and capital markets, and kind of takes advantage of very innovative atmosphere and economy. Let's make sure that happens, but not in a way that undermines either people or the financial system more broadly.
Thank you for that. Staying on cryptocurrencies broadly defined for a minute, and I hate to talk about the war because it's such a horrible thing, but I think we have to, as economists, as people, as financial market participants. It's so important on that level as well. And one of the things that I think is unique today, it's unprecedented, is that cryptocurrency, digital currencies could be playing a role in this conflict. We have seen economic sanctions. We've seen the Russian central bank sanctioned. We've seen many Russian banks removed from SWIFT, the payments messaging system. So it's hyperbolic, but weaponizing capital markets, weaponizing capital to try to achieve geopolitical goals. And one response that people are speculating about is this could push other countries to set up their own SWIFT alternatives so they can do electronic payments outside the US dominated system, not US owned system. It's not owned by any country. But also it could speed up the advancement of some digital payment services, digital currencies. It's been so interesting to me how the US has been more cautious in its approach to a digital dollar. We seem to be moving more slowly on digital currencies in general than some other countries. What would hold us back from having a digital dollar? Is it disintermediating the banks? Is it, you know, we don't need it, the dollar's great, fiat, long live fiat currency? I'm just curious. I mean, the Fed is obviously doing a lot of work on this. We see the Boston Fed with MIT. We see a lot of initiatives going on, but it is clearly slower than most other developed economies and certainly slower than China.
Well, first of all, I think that everybody is working on these issues and thinking about these issues, not just here at the Federal Reserve, but in my interaction with central banks around the world, all of them, this is a top issue. First of all, with the digital currencies that are out there in the private sector, such as stable coins, and how to think about those or maybe regulate that appropriately, but also what's the right role for central bank digital currency, and how does it fit in with the existing digital payment systems we have? Our retail and wholesale payment systems they're electrons moving around. They're not pieces of paper, right? And so how does this solve a problem important for our society, important for our financial system, that isn't being handled with the current system, and what problems could it actually create? So, the Federal Reserve put out a paper on this that really was trying to lay out what the issues are, invited the public comments, and that's underway now. I know our colleagues at the Bank of England have done some great work and in a similar vein, and I know the ECB's thinking about these issues. Everyone's thinking about these issues. I think, for the dollar, the US dollar, it is the international reserve. It's currency. This is the US dollar. We want to be very thoughtful and careful as we think through these issues. I know Chair Powell's made that point. This is, something you want to think about and get right rather than try to rush out. I would also say that China is solving a different set of goals internally in their financial system with their efforts than I think many of the other countries are thinking about. I do think these are big public policy issues. There are technology issues, and the work that MIT's done with my colleagues at the Boston Fed has been great because it's helped us understand the technology, and we're thinking about those issues. But there are really big public policy issues that need to be thought about, of how to best solve some of the problems our financial system isn't so good at, especially think about the high cost of cross-border payments or remittances, or also the underbanked and unbanked. So there are a lot of problems that, maybe the technology can help us, whether it's a central bank digital currency that needs to do that, or there's another way. I think those are open questions. So I don't think we're behind here. I think what we're doing is really trying to study this carefully and thoughtfully, especially given the importance of the US dollar. So I think there's, I don't predict decisions on this, but I think this year is going to be a year of a lot of discussion, a lot of research here and around the world on these issues. So we're going to learn a lot, and that's what I'm looking forward to.
I'm sure, and I'm sure what's happening with Russia and Ukraine will only accelerate some of these discussions, particularly, as you said earlier, around the regulatory. So I have one final question for you, John, tonight, and this is probably the most important thing I could ask. So one of the goals of the Council for Economic Education is to advocate for local and state authorities to teach economics and personal finance. So when kids finish high school and go to college, unlike me, and my parents tried their best, but I didn't really know what I was supposed to do with my credit card. I didn't know how to balance my checkbook. I had no idea what a credit score was, and basics that are going to give them that solid foundation so they can start doing the right financial decision making early in their lives. I was lucky that my university did teach those courses, so I caught up quickly, but we think it should and can start earlier. And I'd love to hear in your words. I know the Federal Reserve does a ton of great educational programming. It's wonderful. I love everything you do. So clearly it resonates with you. Why do you think a basic fundamental understanding of personal finance and economics is so important for young Americans, for the economy? And do schools have a role to play?
I think it is absolutely essential. Both on the financial literacy and managing one's finances, understanding the decisions one makes in life, and they're complicated. They're not intuitive often, and having that information is pays dividends literally throughout one's life. I also think economics education is really important because so many of the issues we talk about in society really, they do revolve around economic issues. Obviously, there's political aspects, there's different aspects, but understanding economics, I think, makes all citizens better prepared to whatever your views are and whatever your political affiliation is, to really understand the issues that are often very much important in our society and in helping our country to really achieve its potential, for everyone to achieve their potential. I'm of an age I didn't learn any economics until I got to college. I'll tell you, when I took my first econ class as a freshman in college, it was eye-opening. I mean, of course, I've been taking economics for the last ever since then. I mean, I feel like I'm still taking it, but it is just learning economics, I think, just helps you think about things differently. It doesn't tell you what to think, but it's a tool that helps you kind of think about things that I think pays lifetime of dividends. Now, I'm also someone who thinks that taking calculus is really valuable, but maybe that's a harder sell.
We won't go there tonight. We'll save that for the next one. John, President Williams, I just want to thank you so much. This has been a really great conversation. I got a lot out of it. I hope our audience did too. I want to give it back to Nan Morrison, CEO and President for CE, and she can sign us out. Thanks again, John.
Great, thanks.
Well, I'd like to thank you both for an incredible conversation. I cannot believe how much ground the two of you covered in an hour. I know it was appreciated. We had a wide range of people listening to us, and this was really, really remarkable. Thank you so much for your time. And we look forward to seeing more of both of you. And also thank you for the plug for the Council for Economic Education and for calculus. I hope to see many of you who are out there tonight at the Visionary Awards coming up. And please continue to ask your schools to support economic and financial education in the classroom. Take care, everybody. Enjoy the spring to come, and with our best hope for everyone who is suffering right now.